And what's your price target on SoFi?
I have a $4 price target and a sell rating, obviously. SoFi has loans at fair value, and they mark them to market every quarter. And they make changes to spread assumptions. They also hedge the portfolio, and the goal of hedging the portfolio is so that if your fair value went up by one, your hedge should go down by one. It's imperfect historically. When you look at that relationship, it's never perfect. The market and hedging is never a perfect one-to-one. But when you take a quarter like last quarter, they did a couple things. They roughly cut the spread assumptions on the student loan portfolio by almost 50 basis points. And they also cut the spread assumption on the personal loan portfolio somewhere between 15 and 20 basis points. But when you think about that, because they're hedged, what that effectively did is they recognized a lot of hedge gains when interest rates went up. But because they cut the spread assumptions, they didn't have a perfect offset. So the loans didn't go down by as much as they would have had they not touched the spread assumptions. And my rough estimate that I've published is that had roughly $125+ million impact specifically in the first quarter. So if you think of that intellectually, that's not really economic earnings. That's really model earnings. The company made changes to the assumptions, and that arguably drove $125+ million of positive revenue.
Even assumptions, you can grow earnings.
So if you look at a quarter like last quarter, where the core earnings outside of the convert gains and other gains that they had was about $22.5 million. But if that included, based on my estimates, $125+ million of one-time events. And if you were to look at an analogy, and I would look at it two different ways, their mortgage companies have MSRs, and they've marked them to market every quarter. And typically, with the mortgage servicing rights, and what they typically do is they effectively back out the model-based changes to fair value every quarter, because those can be fairly large, from their economic earnings. So when they report an adjusted EBITDA or an adjusted net income number, they would effectively back out those gains or those losses in the quarter to provide more of a steady state reflection of cash flow or underlying earnings. So in this case, the argument I would make is that SoFi is also selling loans and recognizing recognizing personal loan servicing rights. And when there are variations quarter to quarter in the servicing right value, which is effectively the fair value premium, they back that out, positive or negative, from revenue, EBITDA, but not net income. But then the equivalent fair value premium on the loans, where they've effectively made increasingly aggressive assumptions, they've effectively pulled forward even more earnings, is driving a lot of those numbers, but those don't get added back or removed from your revenue or EBITDA or even your net income. So it creates what I'd say is like an uneven treatment of the same thing or inconsistent treatment. But when you look at it through that lens, the interesting point that I would make is, I wrote a report which is almost entirely on this topic, was that while they hit the guidance from a reported perspective, taking my numbers, obviously, I estimate that there was $125+ million of positive estimate-driven changes relative to the hedge based on changes in the assumptions. They reported $580.6 million of adjusted net revenue in the first quarter, but based on my estimates, that would have been $455.6 million, which would have been down significantly quarter over quarter and would have been down year over year if they had not changed their spread assumptions.
Okay, that's interesting. So in other words, like when we think about SoFi as a business, so levers are, do you grow personal loans? Do you sell more to banks? Do you take in more deposits than go finance other assets? But one of the other key levers driving earnings is the spread assumption. And the impact of that spread assumption is to the tune of $400+ million, which is enough per quarter. So this is your answer to the question of, well, Noto always hits his earnings.